If you own a home, if you're retired, or if you're counting on your savings and Social Security to carry you through your golden years, you need to stop what you're doing and listen very carefully right now, because the IRS just dropped a bombshell property tax update for 2026 that has homeowners absolutely stunned. And what you don't know about this change could cost you thousands of dollars, threaten your retirement security, or even put your home at risk. This isn't some minor paperwork adjustment or a line item tweak that only accountants care about. This is a fundamental shift in how property taxes interact with federal deductions, senior exemptions, and retirement income calculations, and it is going to ripple through your bank account, your monthly budget, and your entire financial future, whether you realise it or not. The government isn't exactly sending out personalised warning letters to every homeowner, which means millions of seniors and retirees are walking into 2026 completely blind to rules that could drain their fixed income faster than they ever imagined possible. So let me ask you something right now. When was the last time you sat down and really looked at how your property taxes affect your overall tax picture, your Social Security taxation, and your ability to keep money in your pocket where it belongs? If you're like most homeowners, especially most retirees, the answer is probably never, or at least not recently, and that is exactly why this update is so dangerous, because it exploits the blind spots that too many seniors have when it comes to understanding the full weight of property tax obligations and how they connect to federal IRS policy. Let me break this down for you in plain English, because you deserve to understand exactly what is happening, why it matters to you personally, and what you can do starting today to protect yourself, your home, and your family's financial legacy. The IRS has revised the framework around state and local tax deductions, commonly known as the SALT deduction. And while that might sound like technical jargon, what it really means is that the cap on how much of your property tax you can write off on your federal return is not only staying in place, but is now being enforced with stricter documentation requirements and adjusted income thresholds that specifically affect older Americans who own their homes outright or who are living on fixed retirement income. Here's where it gets personal for you. If you're a senior who has finally paid off your mortgage, you might think your property tax bill is just a routine expense, something you budget for and forget about. But under these new 2026 rules, the way that tax bill interacts with your Social Security benefits, your pension distributions, and even your required minimum distributions from your retirement accounts could push you into a higher effective tax bracket without you even realising it until you file your return and suddenly owe far more than you expected. And I haven't even gotten to the part about senior exemptions yet, which is where this story takes a turn that should make every retiree in America sit up and pay attention. Many states offer property tax relief programs specifically designed for seniors, things like homestead exemptions, circuit breaker programs, and deferral options that are supposed to ease the burden on fixed-income homeowners. But the IRS update for 2026 introduces new federal reporting requirements that could complicate, delay, or even disqualify some seniors from receiving these critical benefits if they don't file the right paperwork by the right deadlines with the exact documentation now required under federal guidelines. Think about that for a second. The very programs that were created to help you keep your home as you age are now tangled up in a web of IRS red tape that didn't exist before. And if you miss a single deadline or submit one wrong form, you could lose thousands of dollars in relief that you were counting on to make ends meet. Let me give you a realistic example so you can see exactly how this plays out in real life. Because abstract policy talk doesn't pay the bills, but real money out of your pocket definitely does. Imagine you're a 72-year-old retiree living in a modest home you've owned for 30 years. Your house is worth maybe $300,000. Your property tax bill runs about $5,000 a year, and you've always relied on your state's senior homestead exemption to shave about $1,000 off that bill. Plus you itemize your federal deductions and write off the remaining $4,000 against your pension and Social Security income. Under the old rules, this was straightforward, predictable, and manageable. But under the 2026 IRS changes, your state now has to report your exemption status to the federal government using a new standardized form. And if your state is slow to implement this, or if you don't proactively submit your verification by the new federal deadline of March 15th, your exemption could be delayed or denied, meaning you suddenly owe the full $5,000. And because the SALT deduction cap is still locked at $10,000 total for state and local taxes, Any other state income tax or vehicle tax you pay could max out your deduction limit, leaving you with less federal relief and a bigger overall tax hit. Now multiply that stress across every senior in your neighborhood, every retiree in your family, and every fixed income homeowner in America. And you start to see why people are calling this one of the most underreported financial stories of the year. But wait, because I'm about to tell you something even more concerning that most people haven't heard yet, and it has to do with how the IRS is now treating property tax delinquency among seniors and the connection to banking regulations that could freeze or complicate access to certain accounts. If you fall behind on your property taxes, even by a few months, local governments have always had the power to place a lien on your home. But what most retirees don't know is that under updated federal banking oversight rules tied to the 2026 IRS framework, certain types of tax liens are now flagged more aggressively in federal financial databases, which means your bank could be required to report or even restrict access to some of your accounts if a lien is placed, creating a nightmare scenario where you can't pay the tax because your account is frozen. And your account is frozen because you haven't paid the tax. This is not a hypothetical scare tactic. This is the kind of bureaucratic trap that catches people off guard every single day. And seniors who aren't digitally savvy or who don't have a tax professional on speed dial are the most vulnerable to getting caught in it. Now, I know this is a lot to take in, and you might be feeling overwhelmed or even angry right now. And honestly, you should be, because the system is not designed to make this easy for you. But here is the good news. You are not powerless, and there are concrete, actionable steps you can take immediately to shield yourself from the worst impacts of these changes. First, you need to pull out your most recent property tax statement and your 2025 federal tax return and compare them side by side, because you need to know exactly how much you're currently paying, how much you're currently deducting, and whether you're already bumping up against that $10,000 SALT cap. Second, contact your county assessor's office before the end of January and explicitly ask them about the new federal reporting requirements for senior exemptions. Because if you wait until March when the deadline hits, the phone lines will be jammed and you could miss your window. Third, if you have a pension, an IRA, or any other retirement account that requires minimum distributions, talk to your financial advisor or your account custodian about the timing of those distributions in 2026. Because pulling too much income in a single year could push your adjusted gross income above the threshold where your Social Security benefits become taxable. And when you combine that with a property tax bill that no longer gets fully deducted, you could be looking at a 5-figure surprise tax bill that wipes out months of careful budgeting. Fourth, set up automatic payments or escrow arrangements for your property taxes if you haven't already, because the penalties for late payment are increasing under the new framework, and a single missed deadline could cost you hundreds in fees, plus trigger the lien reporting issues I mentioned earlier. Fifth, and this is critical, make sure your bank has your current address and contact information on file, because if a lien or a compliance notice is issued, you need to receive it immediately so you can respond before any account restrictions take effect. Now, before I reveal the hidden fact about these changes that almost nobody is talking about and that could actually save you money if you act fast, I want to ask you to do something important. If you found this information valuable so far, please take a moment right now to hit that like button and subscribe to this channel, because we are committed to breaking down complex government updates, IRS changes, and retirement policy shifts into plain English that actually helps you protect your money, your home, and your peace of mind. And with so much misinformation floating around, having a reliable source that speaks directly to seniors and retirees is more important than ever. So your support helps us keep doing this work and ensures you won't miss the next critical update that could affect your financial future. All right, here is the hidden fact that most homeowners, most seniors, and even most tax preparers are not discussing yet. The IRS 2026 update includes a little-known provision that allows certain seniors over the age of 65 to qualify for an expanded property tax deduction credit if they meet specific income and residency requirements. But this credit is not automatic. It is not widely advertised, and the application window opens only between January 1st and April 15th of 2026, after which the opportunity closes until the following year. What this means is that if you are 65 or older, if your adjusted gross income falls below the median threshold for your county, which varies by location, but typically sits around $40,000 to $50,000 for single filers and $60,000 to $70,000 for joint filers. And if you have lived in your primary residence for at least 5 consecutive years, you may be eligible to claim an additional federal credit of up to $1,500 against your property tax liability, effectively reducing your out-of-pocket cost even if you have already maxed out your SALT deduction. This is not a deduction, which reduces your taxable income. This is a credit, which reduces your tax bill dollar for dollar, and that distinction could mean the difference between owing money at filing time and getting a refund that you can put back into your savings, your home maintenance, or your grandchildren's education fund. But again, and I cannot stress this enough, you must apply for this credit proactively. You must use the new IRS Form 8996-S, which replaces the previous version. And you must attach proof of your state exemption status, your property tax payment receipts, and a signed affidavit confirming your residency duration. And if any piece of that puzzle is missing, the IRS will reject the application with no appeals process available until the next tax year. So mark your calendar, set a reminder on your phone, tell your neighbour, tell your book club, tell your children to remind you, because this is the kind of opportunity that separates the seniors who get ahead from the seniors who get buried under bureaucratic penalties. Let me also address a common mistake that I see repeatedly among retirees who have paid off their homes, and that is the belief that once the mortgage is gone, escrow handles everything, and you never have to think about property taxes again. This is a dangerous myth, especially in 2026, because without a mortgage servicer managing your escrow, you are personally responsible for ensuring your tax bill is paid in full and on time. And if your county switches to a new payment portal, a new due date, or a new instalment schedule, under state-level adjustments inspired by the federal update, you could miss a payment simply because you were waiting for a bill that never came or that went to an old address. Always verify directly with your county treasurer. Never assume that silence means compliance, and keep physical copies of every payment confirmation, because digital records can glitch, accounts can get hacked. And when the IRS or your state comes asking for proof, you want a paper trail that is bulletproof. Another mistake to avoid is cashing out a retirement account to pay a large property tax bill without understanding the tax consequences of that withdrawal, because not only will you owe regular income tax on the distribution, but if you're under 59.5, you could face an early withdrawal penalty, and even if you're over that age, a large lump sum could trigger higher Medicare premiums through the IRMAA surcharges, could reduce your subsidy eligibility for other senior benefits, and could push you into the territory where up to 85% of your Social Security becomes federally taxable. If you have new on this channel, please subscribe for our support. Tell me where you're watching this video from.